recorded and it'll be shared. You should be getting it in your inboxes at some point after today. And we will be sharing this presentation, so no need to furiously scribble down notes or take pictures or screenshots of the screen. You'll get all of this in your inboxes as well. So with that out of the way, here's the agenda for today's webinar. We're going to start with a brief introduction to provide some context to the Pulse survey. Then we'll share some highlights from the survey itself. All of that should take around 40 minutes, which should leave plenty of time for discussion in this 90-minute webinar. And as I've said, we encourage you to send your questions via WebEx throughout this webinar. No need to wait until the Q&A section. We'll kick off the discussion with reactions from our panelists, and then we'll have an open-ended Q&A moderating discussion between the panelists, the CGAP team, and everyone in attendance today. Now, you'll see here on the top right that I have the Slido information again. I'm just going to switch back to Slido for a moment to see what results we have. And if you haven't had a chance, again, very simple, just go to slido.com in your browser, enter the hashtag CGAP, and it'll allow you to participate in this poll and then in polls that we will be going launching further on. So this first question is actually one that we asked in our Pulse survey itself. In a couple minutes, you'll see how the MFIs in our sample answer the question. But we thought it'd be interesting to see how those of you in the audience would respond. So you can see that the question here is, on a scale of 1 to 10, how badly would you say the microfinance sector in your country is struggling at the moment, with 1 being business as usual, so no impact, and 10 being looming disaster? So it looks like we have about 20 responses here with an average score of about 5.8. Keep that number in mind. It'll be interesting to compare that to what we got in our survey. And then the other question, just to give a sense of who is on the call today, we asked you to categorize yourself by these different types of organizations, and it looks like the biggest is the investor, followed by other, and governmental, intergovernmental association. So very interesting findings. Again, encourage you, if you haven't had a chance to do so yet, go to slido.com in your browser, enter the hashtag CGAP. We'll be coming back to this. I'll actually just keep this open, but for now, I'm going to hand things back over to Peter, who's going to kick off the discussion of our survey. So bear with me just a moment while I do that.
Thanks a lot, Alex, and thanks again to our panelists and to our attendees. I see we have 125 people in the audience right now, which is great. I think we had about 250 or so registered. So hopefully we will even see a few more people come in over time, but we're grateful that you guys are all taking the time to join us. So first, to give a bit of context for the session today, this work is only one part of CGAP's response to COVID. Of course, CGAP has been deeply involved for almost 30 years now in the growth of microfinance, which serves hundreds of millions of low-income people across the world. We're very keenly aware of the importance of financial access for the livelihoods of poor people, for their resiliency to shocks, for the future prospects for the clients and for their children. So we're very concerned now that there's a real risk that the gains that we've all made collectively over the last 4 decades could be really set back significantly by the pandemic. So CGAP has put a freeze on most of the things that we were working on in order to do everything we can to help the microfinance sector and its clients get through this. And we have multiple teams focusing on different things in that effort. One is working on social cash transfers and distribution of those transfers. One is focused on protecting customers of MFIs, borrowers, and depositors. And one is focused on the MFIs themselves, their funders and the regulators, and that's the team that's speaking to you today. The MFI response is in turn focused around 4 key areas. One around the alignment of funders to facilitate more effective collective action across the different constituencies that finance MFIs. The second is around the resiliency of MFIs themselves, giving them guidance and tools for how to get through the crisis and build back better. And the third is guidance for policymakers and regulators who are also struggling to figure out how to confront the crisis. And the fourth is data, providing a common platform, a common foundation of data to serve sort of as a basis for all of the other initiatives. And that's what we're going to be focusing on today. The main focus of the data workstream so far is the Global Pulse Survey. I hope most of you have already heard and seen of it. Maybe some of you have done the survey, but just a few quick words about the survey itself. It was created in response to the need for comprehensive global data that was voiced by many stakeholders as we started to work on this. Different actors have excellent data on specific parts of the sector, but no one really has the full picture. And so the survey was created to fill that gap and get a quick reading of how microfinance is doing across the globe. For funders and policymakers to know what's happening, where it's happening, when it's happening, and for MFIs themselves to see how impact is unfolding across the sector, benchmark how they're doing versus others, and so forth. It's a short, lean digital survey. It works well on mobile phone. It was run initially every 2 weeks. We're now switching to monthly because we recognize that the reporting burdens are heavy and we don't want to contribute to that. Wave 4 has just closed yesterday, actually, and Wave 3, closed yesterday, and Wave 4 was launched yesterday with only 8 questions in it. So if you're an MFI, please do participate in Wave 4. It should only take you a few minutes. For everybody else, we have a public dashboard where everyone can go and analyze the data for themselves. All aggregates, of course, the confidentiality of MFI level data is sacrosanct, but the dashboard is fairly sophisticated. It has pretty advanced filtering and benchmarking tools. You can get a sense from the screenshot here how you can choose from a long list of indicators. You can see averages by region, size, type of MFI, regulatory status, so forth. You can pick 2 different groups and compare the 2 and so forth. So it's quite powerful. If you haven't checked it out already, please do, because I think it's a public good and it's the reason that we're doing the survey. For participating MFIs, we also offer a private view where they can see and benchmark their own performance against others. That's through a secure link that's only available to the person who uploaded the data, and we're hoping that will help them understand how the crisis is unfolding, how they're comparing to others, and help them thereby to sort of plan and manage the crisis. So please do use the dashboard. Tell us what you think, what features you want to see added. I hope that the MFIs in your networks have all participated in the survey, by the way, because without data, this nice dashboard and all the work going into it is useless. If not, please do encourage them to join. This really is the only way that we can get global data on how the sector is doing, who needs help, and what help they need. So much for the background. Let's start getting into the findings. So for the next 30 minutes, we're going to share highlights from the survey focused around 3 main areas of interest. The first being liquidity, second being portfolio quality, and the third being the operational changes that MFIs have made to lending, staffing, branches, and so forth. First, let me say a few words about the sample. So this is our sample for Wave 1. As you can see, we got 314 MFIs with average assets of around $73 million US. Collectively, they represent about 19 billion total assets, so a fairly significant portion of the space. In terms of the quality and representativeness of the sample, we think it's fairly good. The geographical distribution is not bad. All major regions represented. Sub-Saharan Africa and LAC in particular, very well represented. We would have loved to see a few more in South and Southeast Asia, but at least we're capturing the bigger MFIs here, as you can see from average assets. ECA and MENA, so Europe, Central Asia, and Middle East and North Africa are the 2 regions where we have a more limited sample. That's worth keeping in mind as we go through the analysis, that we don't, we're less confident about those regions because the sample is smaller. We have a smaller market, so there are fewer MFIs there as well, but but that's worth bearing in mind. A couple more caveats to bear in mind as we go through the data. First of all, these are all self-reported, so there could be errors in there. The survey tool is quite sophisticated and dynamically tells you what currency you're using and stuff like that, but people still make mistakes, so there could be errors. We are checking, of course, but sometimes things slip through, so that's an important caveat. There could be selection bias. We're trying to reach out through as many channels as we can, but it could still be the case that we're only reaching the bigger, more internationally connected MFIs and not the sort of smaller, more local ones. It could be that only better performing MFIs have the time or the desire to participate in a survey like this, which could create a skew towards better performance and so forth. And finally, the samples do vary between waves, and we ask different questions in different waves. Participation in waves 2 and 3 has been a little lower, which is why we're now making it both shorter and less frequent. So those caveats are all worth bearing in mind as we go through the data. That said, despite these limitations, we do think these are useful data. This really is the best and only representation of what's happening globally that really is available today. So part of the point of the survey is to take a real-time pulse of the sector, hence the name Pulse Survey. And one way in which we do that is to ask the question that Alex mentioned earlier that we're posing to you on the Slido, namely, how badly would you say the microfinance sector in your country is struggling right now? The point of that question is to get beyond the sort of dry ratios and nitty-gritty financials, many of which, for accounting reasons, have a lag of a month or so. And we wanted to really get a real-time, sort of comprehensive gut feel sense of how are things going right now in your market. And we first asked this in mid-June, and the responses came in fairly high across the board. Nearly all regions between 6 and 7, the average was 6.2. And you'll recall from the Slido earlier that the audience that had answered at that point, at least, had a 5.8 average, so slightly more optimistic than our respondents were in the first wave. This is well past severe stress, as you can see, but still short of the more apocalyptic measures at the higher end of the scale. The second time we asked was in early mid-July, and there we actually see that the average comes closer to the metric that we got from the audience right now, which is interesting. We are compiling wave 3 right now, so it's going to be interesting to see if that downward trend persists. Now let's dive into the hard findings. And we thought we would start by looking at liquidity, which has been the subject of a lot of discussions right from the beginning of the crisis, of the pandemic. Many people early on sounded the alarm for a looming liquidity crisis among MFIs, but over time, there's been anecdotal evidence coming in that suggests that maybe liquidity is okay after all. So it's been hard to know what is the real verdict. So let's see what the Pulse survey tells us about that. Well, the headline message is that liquidity overall is better than we would have feared. So what you're looking at right now is a graph that Dan Rosas created with 2016 data from the mix. We can think of this as a pre-crisis baseline of liquidity. And what it does is show how many months of operational expenditure, OPEX, MFIs are able to sustain with the cash and liquid assets that they have on hand today. So you see the number of months less than 1, 2, 3 to 5, and so forth, all the way up to beyond 2 years. And what Dan Rosas showed was that 20% of MFIs had cash reserves less than their OPEX for the coming 3 months, which seems to be a useful benchmark. Here's what the graph looks like today using the Pulse survey data. This is data as of 30 April 2020, and we will have updates on it shortly from the most recent wave. We don't want to overinterpret the comparison since these samples are different, but what we see clearly is liquidity buffers are certainly no lower than pre-crisis levels, and if anything, they are actually higher. If we zoom in on that share of MFIs that has cash less than 3 months OPEX, we see that, again, it is slightly lower than it was in the pre-crisis period. Now, it's important to note that this shows liquidity on 30 April versus OPEX for Q1. The reason being a lot of MFIs only calculate OPEX on a quarterly basis. That means OPEX cuts that happened since the end of March aren't yet reflected, which in turn means that the actual cash ratios might be even higher. Probably they are. We collected Q2 OPEX in the way they closed yesterday, so we're going to be able to update this analysis soon. But the broad conclusion from this is that we are not seeing any evidence of a generalized liquidity crunch, at least for now. That said, nearly 1 in 5 MFIs have less cash than 3 months of OPEX. 1 in 10 MFIs have only cash enough to cover them for 1 month or less, which is obviously very worrying. So the question then becomes, which MFIs in the sector are more exposed to liquidity risk? So we can break down the sample across regional lines, for instance, and see a few interesting things. There's a lot going on here, but if we zoom in on that same group of MFIs that have less than 3 months of OPEX, we see that about a fifth of MFIs in LAC, Latin America and Caribbean, have less cash than 3 months OPEX. And in Sub-Saharan Africa, similar figures, about 1 in 6 MFIs. MENA is also low with the sample is small, so we don't want to over-interpret that. But those two regions of SSA and LAC, we have plenty of sample, and there does seem to be a subset of MFIs that are short on liquidity there. That said, most of the sector seems to have plenty of cash. In most regions, more than half of MFIs have enough cash to last them for over a year at pre-crisis OPEX levels, and even in LAC, over more than a third of MFIs can run for a year. So it's certainly big parts of the sector are just fine on this metric. It's important to note also that how much risk is implied by low liquidity really depends on the MFI. Better run institutions might need less of a cushion because they're more efficient, they're better at forecasting cash needs, they're dispersing more, et cetera. If you're a lender, then just sitting on a ton of cash obviously isn't inherently a good thing. You want to be lending it. But this certainly shows which parts of the world we may want to look closer at liquidity levels, notably then LAC and Sub-Saharan Africa. If we look at distribution by size, unsurprisingly, large MFIs tend to have deeper cash reserves. Zooming in again on that 3-month metric, just 6% of MFIs with total assets over $100 million fall into that category. Among the smaller MFIs, nearly a quarter of MFIs with less than $10 million total assets have less cash on hand than their 3 months operational expenditure. And the same goes for about 1 in 6 mid-sized MFIs. So there's a clear skew on size. But again, most of the sector has ample liquidity. Around half of MFIs in every category has enough cash to run for a year or more. And among the biggest ones, it's around 70%. Now, of course, OPEX is only one of the things for which MFIs need liquidity. If we add in upcoming debt payments to funders, then the cash buffers will drain faster. The left graph here is the same as before, but on the right-hand side, we're adding in the debt payments that are scheduled for the next quarter. So it's current liquidity, cash on hand, versus cash and 90-day liquid assets versus 3 months OPEX and 90-day debt repayments. And what we see is nearly a third of MFIs have less cash on hand than the OPEX plus debt repayments for the next quarter. So the share of MFIs with quote-unquote low liquidity doubles when we include debt repayments. And that obviously underscores the refinancing risk as it relates to liquidity. If funders don't roll over debt financing, then it could create liquidity problems for MFIs that otherwise wouldn't have any. Now, so far, all this has been based on our analysis and our judgment on what constitutes a low liquidity. So in wave 2, we went ahead and we just asked MFIs themselves how worried they are about this. The sample here is a little smaller, it's about 150 MFIs, so we should bear that in mind. But with that in mind, it seems to align fairly well with our liquidity analysis. 29% of MFIs say themselves that they anticipate a liquidity shortage in the next 90 days, which tallies pretty well with the 31% of MFIs we saw on the previous slide who have liquidity less than 3 months OPEX plus debt repayments that are scheduled. So almost 1 in 3, 29% of MFIs are worried about liquidity. Perhaps more worryingly, 35% of MFIs say that they expect solvency issues in the next 6 months. Obviously, fairly high number. That is some cause for concern. The good news is that these MFIs have typically already discussed these concerns with their funders. We asked about that. So 22% of MFIs have already talked about debt moratoria with their funders. That's compared to 29% who expect liquidity issues, so tallies fairly well. And almost the same 22% have discussed debt restructuring. When it comes to solvency, around 20% or 1 in 5 MFIs have talked to funders about capital increase. Interestingly, 42% of MFIs haven't had any of these discussions with funders. But so conversely, 60% of MFIs have had discussions with funders about at least one of these things. For the MFIs that have had discussions with funders, we asked, have you managed to reach an agreement in those discussions? And when it comes to moratoria, 3 out of 4 discussions have led to an agreement with funders. When it comes to debt restructuring, 2 out of every 3 MFIs who have talked about that with funders say they have an agreement with funders around restructuring their debt. Debt cancellation, there are fewer agreements. Only about 1 in 8 MFIs who've talked about these things say they have an agreement with funders on canceling debt. It's not surprising. It's a bigger step, of course. And around half of MFIs who have discussed capital increases with their funders say that they've reached an agreement with funders, just shy of half. Now, overall, I think we would say these are pretty positive findings. Obviously, around a third of MFIs have concerns about liquidity. That's not great, but it could be worse, frankly. But most importantly, all of them seem to have raised these concerns with their funders, and the vast majority, 80% of those discussions, have led to agreements with funders. It's not surprising to see that solvency concerns are a bit stickier. Only about half of MFIs who have solvency concerns have discussed capital increases with their funders. That's a slightly bigger step. And only half of those discussions have led to agreements. So, but overall, I think this speaks to a pretty healthy relationship between MFIs and funders, that MFIs are comfortable signaling issues and asking for help, and funders are willing to give that help. In wave 2, we also asked MFIs about what operational changes they have made in response to COVID-19. And by operational changes, we mean things like reducing disbursements, giving leniency to clients, closing branches or agents, doing work from home, reducing hours, furloughing staff, expanding the use of remote channels, and so forth. Again, the sample here is around 150 MFIs. The most striking finding, perhaps, is that more than 2/3 of MFIs have reduced lending. I think, obviously, that's not unexpected per se, but I think the sheer extent of it is still mildly shocking when you see the number. Moreover, most of those MFIs have cut lending by pretty significant amounts. So more than 2/3 of MFIs who reduced lending say that they cut lending by more than half compared to normal levels. So very significant cut, and 1 in 10 say they've stopped lending entirely. It's worth noting that we don't know why they reduced lending. It could be lower demand from clients. It could be an increased risk profile among clients. They've lost their jobs, they had to close their businesses, and so forth. It could be a lower risk tolerance from the MFI, changing risk standards. It could be tighter regulatory standards. And it could just be cash hoarding conservatively to meet an uncertain future. So there could be lots of reasons why that is happening. Whatever the reason, this is likely one factor that's bolstering those liquidity buffers that we saw earlier, and a reason why MFIs seem to have a fair amount of cash on hand. When it comes to the existing loan portfolios, the clear majority of MFIs are giving leniency to clients. So around 2/3 of MFIs are issuing moratoria to clients due to COVID, and the same goes for loan restructuring. That's obviously quite encouraging from a client perspective. For the most part, they haven't started writing off loans yet. Just 1 in 10 say that they're doing more write-offs due to COVID, which makes sense because only after moratoria run out and the restructured loans come due will write-offs really come into question. And that will be the key question. How many of those deferred or restructured loans on the left are eventually going to move into the write-off column? Worth noting that only 15% are doing any of these things. So that means 85% of all MFIs in our sample are giving clients some form of leniency, which is obviously great. We were quite interested to know about the moratoria, whether they are mandatory or voluntary. And it turns out that around 1/3 of MFIs that offer moratoria say they're doing it because it's mandatory, but the other 2/3 are doing it on a voluntary basis. because presumably they know that their clients are having trouble and they're offering them that leniency. We also wanted to know who is eligible for a moratorium. And it turns out that the most common approach, nearly half of MFIs, is to give it to all clients who ask for a moratorium. 46% of MFIs do that. But there's a range of practices. A bit less than half of MFIs are giving selective moratoria, so clients that meet certain criteria are eligible for a moratorium. Most of those are setting those criteria themselves, but some of them, about a fourth, are saying that the authorities have decided who gets a moratorium and who doesn't. And 14% of MFIs give blanket moratoria to all clients. You don't even need to ask for it. Everybody just gets a moratorium straight up. We expected to hear about significant branch closures, but we're actually not seeing that to be either very common or that extensive. Only 16% of MFIs reported branches being closed currently. And again, this is pretty current. It's as of 22nd of July. Of those MFIs, the clear majority have shut down less than 20% of their branches. 2/3 of MFIs that have shut anything down have only shut down less than 20% of branches. Now, this could be that economies are starting to open back up again, and hence there were more closures earlier in the course of the pandemic, but MFIs have started to open up again. We don't know. We don't have those historical data points. But if so, that obviously augurs well for their ability to rebound as economies pick up speed again. While the branches are open, when it comes to staffing, most MFIs implement staff measures. Just over half of MFIs have staff working from home. Around 40% have reduced hours or put staff on leave, either paid or unpaid leave. However, again, most of those measures affect a limited portion of staff. More than half of the MFIs who reduced hours for staff said that they apply to less than 20% of their staff. So they reduced hours, but only for 1 in 5 staff. Of the MFIs who do home-based work, the majority, 2/3, say it applies to less than 40% of staff. So again, most staff are unaffected by those measures. That said, 1 in 8 MFIs say that they have more than 80% of staff on reduced hours, which is obviously very significant. Now, branches may be open and staffed, but that doesn't mean the clients can or want to come in, and hence many MFIs are expanding the use of remote channels to clients. There's a lot of talk about digitization. We do see that, but actually call centers are the most common response in our sample. 35% of our MFIs say they've expanded call center operations. That said, there clearly is a push on digital as well. 31% of MFIs are expanding digital channels that they already had in place, and 29% are adopting new digital channels. So those things are definitely also happening. Of course, that's oftentimes starting from a low base. If we look at the share of current transactions that are on digital channels, we see that 40% of MFIs say that they're doing at least some transactions over digital channels, which is good. But only 1 in 7 are really doing any volumes, namely that it's doing more than 30% of transactions over digital channels. A quarter of MFIs aren't doing any digital transactions, and a third of MFIs can respond to that question, which we struggle a little bit to interpret, but it probably doesn't mean that they're doing a lot of digital transactions if we had to guess. So there's clearly a push on digital, but starting from a relatively low base in a lot of cases. We're going to be tracking this indicator a few times over the course of the survey, so it's going to be interesting to see how it evolves over time and whether it correlates with their ability to get through the crisis well. This is a summary overview of all the measures taken. We could come back to it if people are interested, but I thought it tells a pretty clear story about the prioritization of the MFI. So clearly the most common measures are all portfolio related to curb lending and give customers various kinds of relief through moratoria and loan restructuring. More than 2/3 of all MFIs are doing these things. It's the #1 set of responses. The second most common is staff measures, work from home and reduced hours. Around half of MFIs are doing that. And expanding remote channels is the third priority. A bit less than half, around 1/3 of MFIs are doing that. Branch closures, staff redundancies, write-offs, and those kinds of more extreme measures are all much less common, thankfully. And with that, I will hand back to Alex to speak briefly about portfolio quality, which is the last of our 3 segments
Thank you.
on the results of the survey. and then we're going to get over to our panelists to hear from them.
Thank you, Peter. And before we go into this section, just wanted to share a quick reminder. Again, please do share any questions or comments you have in the chat function or in the Q&A panel. We are keeping an eye on those, and we'll do our best to address them either via verbally as we're talking or just directly in the chat. I see several people have posted things there. Please do keep them coming, and we'll do our best to address them. So we've now covered liquidity and the actions that MFIs are taking right now. In this section, we'll discuss what may be more of a medium or a long-term risk. And specifically, we're focused on the extent to which the pandemic is causing asset quality of MFIs to deteriorate, and whether that deterioration could threaten the medium and long-term solvency of the sector. Here we see that PAR 30 across our sample has increased dramatically. In June 2019, which we take as a baseline, a year before the pandemic, PAR 30 was at 5.4% across our sample. Then in late April of this year, it went up to 8.5%. And then just 2 weeks later, in mid-May, the figure went up to 10.5%. So it's important to note that what I'm showing here on this slide is a weighted average. We weighted the MFI responses by total asset size. And what this gives us is an approximation of how the totality of MFI loans is performing. I'll say more on that a bit later. And here we see that the pandemic has seemed to cause an increase in PAR across all regions. There's a slight dip from April to May in Europe and Central Asia, but that may just be noise due to the small sample size we have in that region. We have larger sample sizes in sub-Saharan Africa and Latin America and Caribbean regions, and so the figures there are more likely to be accurate. And what we see in sub-Saharan Africa is that the region started with higher PAR levels, which did start to increase in April and May. In the LAC region, there was a slight uptick from the baseline 2019 to April 2020, and then a big jump going into mid-May. But here again, the sample size for mid-May is relatively small, so bear that in mind when trying to interpret the data. And here, what I wanted to show is just that what the simple average looks like in comparison to the weighted average. And so comparing the 3 bars on the far right with the 3 bars that are just to the left of that, what we see is that the simple average PAR levels are higher. They start off higher and they also double. Now, the simple average is showing more how the average MFI in our sample is performing, how their portfolio is doing, how each MFI is doing. This is in contrast to the weighted average, which indicates how the totality of the MFI sector's loans are performing. It's a subtle difference, but an important one. And the fact that the simple average PAR is higher indicates that smaller MFIs tend to have higher PAR levels, which is an issue that we dug into a bit further, that MFI size. And you can see here that we divided up the MFI universe in our sample into 3 categories. On the left, we have the smaller MFIs with less than 10 million in assets, with the largest having over 100 million, and the medium ones having between 10 and 100. And you can see here on the far left that there is clearly an inverse correlation between MFI size and PAR levels. Smaller MFIs have higher PAR. We also want to dig into the issue of whether MFIs focused on women had higher PAR levels. So in our survey, we did ask MFIs if more than 60% of their borrowers were women. And on this slide, we're just comparing PAR levels of those who said no on the left in this chart with those who said yes, just to the right. And what you can see is the MFIs with more women borrowers do indeed have higher PAR levels. But when we dug into this issue further, we realized that having more women borrowers is highly correlated with being a smaller MFI, having smaller loan sizes. And it's not clear from the data if the gender focus or one of these other factors is what's driving the difference. We did also try to look for patterns in PAR using other variables. So we looked, for example, for correlations with digitization, regulatory status, other variables. We haven't found any clear signals yet with those other variables, but we're still working on it, and we are expecting to get more data. So stay tuned for more information on that. Of course, we know that PAR 30 does not solve the portfolio quality puzzle by itself. There are other pieces, and write-offs are one important piece to consider, but with April-May data, it was probably too early to see much of an uptick in write-offs as a result of the pandemic. What is much more significant here is the impact of the restructured and rescheduled loans, including those that were due to moratorium. So Peter mentioned what various reasons why moratoria are being put in place. And what we're showing here in this chart is the restructured and moratoria levels stacked on top of PAR. So looking at the far right, what we see is the total simple average across our sample of PAR 30 is 12%, and then the restructured plus moratoria is 20%, so that sums to 32%. And that 32% figure is something that we call troubled portfolio. And it's this troubled portfolio that I think is really the most interesting and intriguing figure out of anything that's come out of our data. Ultimately, what happens to this portfolio is what's going to determine the impact that the pandemic has on the solvency, the sustainability of the MFI sector. So up to now, I've been talking about the riskiness of portfolios, but relative to what? Equity, as we know, is what's there to absorb unexpected losses. It's what stands between an MFI and insolvency. And here on this slide, we see that the MFI sector as a whole went into the crisis with strong balance sheets. So the average across our sample of equity to assets was 28%. And looking at the right on this chart, you can see that smaller MFIs tended to have higher equity levels relative to their total assets. Now recall from the earlier slide where I showed that smaller MFIs have higher PAR levels. So smaller MFIs thus carry more risk on their balance sheets. So it makes sense then that smaller MFIs would also have higher equity levels to protect against that risk. The key, of course, to assessing solvency risk is comparing the equity that an institution has to the potential losses that could erode that equity. And that's what we're trying to show here. As you can see, the MFI data that we used for this analysis showed a higher equity level at 34% than a troubled portfolio level at 27%. So is that enough equity to protect against the risk of that portfolio? The answer, of course, is it depends. And here on the right, we're showing 4 scenarios. In this first scenario, MFIs end up losing 20% of that troubled portfolio. So we'll put another way, of all the loans in that troubled portfolio, we're assuming in this scenario that MFIs are only recovering 80 cents on the dollar. So the result in this scenario, and using very simplified assumptions, would be that equity would decline to 29%, which is still a pretty strong balance sheet. We then have 2 intermediate scenarios, assuming 40 and 60% losses. And then in the fourth scenario, we're assuming an 80% loss. So the MFIs in this scenario are only able to collect 20% of that troubled portfolio. And even here in this, what I think is probably a pretty catastrophic scenario, equity remains at 12%. This definitely gets into solvency risk territory, but is still pretty well survivable. Now, of course, there are a number of caveats that I need to mention here with this analysis. First of all, this is stylized and for illustrative purposes. We did not collect complete financial statements from firms, and even if we did, we couldn't possibly conduct a proper stress test here. This is just to illustrate a point. We had to come up with several assumptions, some of which are detailed in the footnotes here. And even beyond that, we're dealing here with an average, so there's a lot of variability underneath that average. There's also regulatory risk, which is somewhat distinct from the pure solvency risk, so that 12% figure may be sufficient from an economic perspective to keep an institution alive, but regulators may have other thresholds and definitions for determining capital adequacy. And last, and probably most importantly, this data is from early in the pandemic. If that troubled portfolio increases and the equity decreases over time, solvency would become much more of a serious threat. So in that previous slide, we were using global averages, but clearly regional breakdowns would be much more interesting. But to get those regional breakdowns, we need more observations. And to do that, we need to get a bit more creative with the data, which is what we're going to do in this slide. The slide is going to get a little bit messy, just to warn you, but I'll walk you through it, and I think it's going to be worth it. So here I'm showing figures on the far right, just to start. And in this first column in dark blue, you see the par levels as of April 30 at 12%, and then restructured and moratoria on top of that 20%, so total 32% of troubled portfolio. And then in the column one over to the right, you can see the par increased to 16% by mid-May. And we didn't get restructured portfolio data from mid-May, but if we assume that it stayed at 20%, which if anything, it probably grew, so this is maybe a conservative assumption. We can carry that forward, which is what we did with that box with the dotted line. And you can see that the troubled portfolio would be 36%, or actually probably at least 36%. So up to here, we're showing troubled portfolio as a percent of the total portfolio, the gross loan portfolio across our sample. But as we move over to equity, now we're showing that as a percent of total assets. So we're not exactly comparing apples to apples here, as we did in the previous slide, and you can't do the simple arithmetic of just subtracting to look at the difference or to build scenarios. But this approach, I think, is interesting, and taking this approach with the data that we have available allows us to look at equity and troubled portfolios side by side. The larger sample size also lets us dig into some comparisons across regions. And you can see here that the figures in South and Southeast Asia look alarming. So that 55% troubled portfolio compared to just 22% equity, where if we apply that 20% loss of the troubled portfolio, that would cause serious solvency stress. But here, if you look just below that, we have the sample sizes, and they're relatively small for the size of the sector in that region. So take that really with a grain of salt. The LAC and Sub-Saharan African regions are where we have better data. And you can see that in both of those regions, the equity to assets ratio started at around 28%, but the Sub-Saharan Africa portfolio looked quite a bit worse by mid-May. So that's all we have on this section. And what do we make out of all of this? Is there an impending solvency crisis? I think it's impossible to really say for certain, but if I were to make a guess, at least as of May 15th, there wasn't a significant risk of an across-the-board solvency crisis, but we still have many more questions than answers. I've mentioned a few of those as I went through these slides, but just to reiterate them here, these global and even the regional averages mask a great deal of variability. There are certainly, without a doubt, subsegments of the MFI ecosystem that are facing solvency risk, even as of mid-April. And of course, mid-April was very early in the crisis, particularly for a lot of these regions. There was quite a bit of deterioration in asset quality in just the 2 weeks from April to May, where we have the data. And if those trends continue through June and July, things would probably look much worse now. We are going to be collecting data on June 30, so stay tuned for more information about that. And of course, last but not least, we are all at the mercy of the virus. The direction that all of these figures go are going to depend a great deal on how the pandemic plays out, which of course also depends on how governments, donors, investors, and other stakeholders react. So that concludes the presentation survey highlights. We're going to turn over to discussion, starting with the panelists in just a second. But before we do that, I want to go back to the Slido. So quick update, it looks like we had a couple more responses. The average here went to 6.1%, where I think it was 5.9 before. I'm going to open up a new survey where we have 3 questions. So you've seen our presentation now. Let's get your thoughts. And again, just a reminder, go on your browser using whatever device you have, to slido.com, enter the hashtag CGAP, and you should see 3 questions there. Do you believe that the sector is likely to experience a liquidity crisis in the next 6 months? 1 being not likely at all, 5 being extremely likely, 3 being somewhere in the middle. The next question, solvency. Do you believe there's going to be a solvency crisis in the next 6 months? Again, scale of 1 to 5. And lastly, there's a question about the liquidity drivers. What do you think is driving some of the liquidity that Peter presented? He showed that there wasn't as much of a liquidity crunch as we might have expected, but I don't think we have a clear answer as to what's really driving it. So what do you think is driving it? I'm going to leave this poll up and we'll come back to it when we get to the audience Q&A. Again, just use your browser, go to slido.com, enter the event code CGAP, and we're going to come back to this after our panelists have a chance to chime in with their reactions. So for the panelists, we're asking you to please take about 5 minutes to share your perspectives on these issues. And we have 4 questions here. First, what are you seeing? So to what extent does what you see correspond to what we've just shared in the presentation? Do you have any updates? Our data is from May. What are you seeing now? How is all of this affecting you as an organization in your role? What are you planning to do about it? So actions that you are planning to do or actions that you've taken. And then where do you think greater collaboration is needed? Where do you think that we might benefit from some collective action across multiple stakeholders? Is there any asks you would have of other stakeholders who might be in the audience today? So, as I've said, we have a really distinguished group of leaders in the microfinance ecosystem here with us today. Really excited to have them here to share their reactions and get their experiences with us. We're going to start off with Momina Aijazuddin. She is the Global Head of Microfinance and Financial Inclusion at the International Finance Corporation. Her role there covers both the investment and advisory sides of the IFC's business, and that includes over $6 billion in cumulative global investments across more than 300 MFIs and 60 advisory projects across more than 30 countries. And beyond IFC and her specific role, Momina has been a key player in advancing financial inclusion through numerous global initiatives, including the Responsible Finance Forum, the G20 Digital Financial Inclusion Principles, and the World Bank's Universal Access Initiative. Really excited to have her here today. Momina, over to you.
Thank you, Alexander. And hello, everybody. Very pleased to join you here today. So much of what you described, Peter and Alexander, resonated with me. I think we're seeing a very similar experience. So, and we've been discussing this offline. I think what was clearly interesting to me is that most of these MFIs have reported severe stress, and men are experiencing the most. And it's no wonder, because a lot of the MFIs in MENA tend to be non-deposit taking NGOs. You also anticipated liquidity shortages or liquidity turning into solvency issues, which we're seeing, and an uptake in power. So very briefly, I mean, from IFC's perspective, I mean, what we're seeing is clearly that COVID has grown from a health to an economic crisis. We're seeing a huge impact on, the ILO estimates 81% of the global labor force will be affected by this, and 100 million being pushed into extreme poverty. So there are huge spillover effects outside the MFI universe, which are obviously affecting performance. What we're seeing is like base of the pyramid providers have significant disruption to their operations, financing, liquidity, and asset quality issues. But again, this really is very highly dependent on country context rather than regional. So what I'm seeing is, for instance, like the state of the economy upfront before COVID was a key determinant. So, when I think of countries like Lebanon, etc., which are going into, huge political, economic, social issues. The MFIs there will be disproportionately more affected than the ones which are in markets which are less so. We're seeing the same in Bangladesh, and there are tangential effects. So in Lebanon, 2/3 of clients will, amongst one of the MFIs that we work with, would probably need grants and not microfinance loans in the future. In Bangladesh, a lot of the MSMEs have been shut down. In Cambodia, 200,000 government workers have been laid off. So of course, that puts a huge imposes a huge change in terms of what the MFI universe will be in terms of future clients. So it's no surprise to me the demand is going down. I think the second thing we're seeing is that and this came through I think in some of your regional comparisons, but not explicitly, that there's a difference between the deposit and non-deposit taking institutions. I think in terms of size, the non-deposit taking NGO slash credit-only providers are facing a disproportionate impact. And part of that is because they don't have access to the same kind of liquidity lines available. I see one of your participants is in Pakistan. There was a huge difference there between the deposit-taking entities or the microfinance banks having access to the central bank lines, whereas the non-deposit-taking ones were not. And obviously, this plays a role. I think the second thing we're seeing is that many of these MFIs, I think, contrary to previous crises, when I think back to 2009 or even some of the crises before, crisis is no longer new to the MFI industry. It is maturing. So, one thinks of, India having gone through the AP crisis, or revolutions in in Egypt or Tunisia, or recessions, or, like the macro issues in Nigeria. So a lot of MFIs have had experience, particularly the larger ones, in dealing with crises or cash flow issues, liquidity, risk management. I think where we will end up seeing a larger impact, and we're seeing it on two sides. One is the liquidity. I think most MFIs, as in your survey, are okay with liquidity in the short term. So most have taken preemptive measures and have 3-month or 6-month liquidity. I see a shortage of longer term tenors. So like 2-3 year money is not available. Banks are not keen to lend that even in local currency. And we're seeing a lot more demand for 3 to 5 year money because there is such uncertainty on that. And the second aspect we're seeing is confidence, really on the investor side, dropping down, especially on equity. I think we've all had to face, reduced valuations on equity. We've taken hits on our equity portfolio, even at the IFC. And part of it is there will be changes in terms of expectations on equity returns, valuations, and whether new capital will be available, right, to the point where we do expect solvency to be an issue as repayment rates fall, as borrowers are struggling to make ends meet. But then where will that liquidity or solvency come from? So, on the IFC side, we have a large portfolio. We're one of the biggest investors in this space, and half of these projects are in IDA countries, which are the poorer countries, and almost 20% is in FCS or fragile and conflict affected. So what we've been trying to do is multifold, I think, on focusing on the business intelligence, data collection, stress testing, and making sure that beyond our own portfolio, that MFIs have access to, World Bank or a central bank liquidity lines, etc., that there's policy dialogue and guidance at the national level, in conjunction, of course, with CGAP and our World Bank colleagues, to see like what interventions can take place, which will allow the microfinance sector to benefit from some of the government actions. And then on the outside, we've been trying to coordinate with other DFIs, EBRD, EIB, etc., and the microfinance investment vehicles on like standardized approaches for reschedulings and deferrals. We've had very little requests for deferrals, and I think part of it has been that most of the MFIs we tend to work with are at the upper end in terms of like deposit taking stronger institutions. But you can even see at a country level, in a country like India, for instance, the bigger universal commercial banks, even focused on microfinance, whereas Bandhan will have easy access to liquidity. So will the payment banks. But when you go into like the non-deposit taking entities, that's when you run into issues in terms of liquidity and solvency. So the most extreme, I mean, what we're trying to do at the IFC is structure a base of the pyramid facility, which will supplement a $2 billion initiative that we had taken under COVID to address the financial sector. And part of it is to de-risk in terms of using, hopefully, either resources to provide working capital and liquidity to lines. And we're also looking at structuring facilities with solvency for, to support some of our plans. I think, I mean, I'd love to hear from the others. I think as countries open up, my main concern is that MFIs or NBFIs, the smaller institutions may not get the relief they need. And if they're not included in relief measures, these institutions could well fall away and not survive the pandemic. Obviously, we have a role to play in this by, providing liquidity or mobilizing other investors and providing countercyclical capital or expertise. But beyond that, I'm wondering what the gap will be for institutions which are serving rural or base of the pyramid players, and which may not be fully commercial, and they may disappear. So who then fills in the gap to reach the structurally excluded populations? I think on your, just my last point is on the portfolio at risk. I mean, what we're trying to do is really monitor very closely, whether 30-day, 60-day, and this really is very dependent on collections and disbursements. Disbursements on average are going down in most of the MFIs that we're working with. But thankfully, there haven't been much in terms of deposit reductions or deposit runs, and that really does help in terms of ensuring that the MFIs that one is working with are structurally sound. So I'll just pass over back to you, but I think I'd be keen to hear from others what their reactions are.
Thank you, Momina. Thanks so much. That's really interesting insights into the variability that I alluded to that was really lurking somewhere beneath the data in terms of the different subsegments, and really appreciate hearing the insights directly from you on various areas where you perceive more risk, and also really interesting to hear about what IFC's potential plans are and actions with respect to helping to support the sector.
Sorry, Alexander, I just forgot one last thing on the advice.
Sure.
It's the digital capability. I mean, the MFIs that we're seeing which have digital capability or contactless solutions are doing much better than the ones who are not.
Yeah, that's really interesting. We looked at that in our data, but we struggled to find a really clear signal there. We're still working on it, but that's a really interesting finding in and of itself, how digitization can help with resilience. I'll be really interested to hear what our other panelists have to say about these issues. At this point, we're going to turn over in a moment to Jérôme Savelli, who's the Chief Risk Officer at Symbiotics. He started working there in 2006. That's just 1 year after the company was founded, and he held a variety of leadership positions across the investment and risk teams there, and has helped Symbiotics grow to what it is today, which is a leading impact investment platform responsible for investing over $5.5 billion in frontier markets since its founding. Jérôme, over to you.
Thank you, Alexander. Hi, everyone. Well, first, I want to congratulate CGAP for running this pulse survey, which definitely provides valuable information and demonstrate once again the ability of the sector to be transparent and reactive in the way it reports data. So Symbiotics is in a constant touch with microfinance investors and institutions. We receive from the latter information every month on our online reporting system, which allows us to have a good visibility as well on what's going on. And fortunately, what we have observed so far does not significantly deviate from the result of the CGAP survey. Back in March, April this year, we initially saw institutions indeed struggling with liquidity due to the lockdowns and moratorium on payments in place in many countries. Institution operated in crisis mode, and I am sure Andrée will be able to confirm this, seeking to maintain operations while protecting their clients' and employees' health. We haven't observed any specific regional focus, as Momina was pointing, but rather country focus impacts. The effect logically followed the timing of the virus propagation, but also depending on the specific government reactions that had a huge impact on the way the institutions reacted. So following those liquidity issues, like other MIVs, we had to deal with the immediate liquidity situation. And Symbiotics received, unlike IFC, numerous requests of debt rescheduling following the first lockdowns. And we had about 30% of our investees that reached out to us in this regard. And that's when, at this point, we agreed among the major MIVs on a light and easy way to set up a framework for debt renewal to safeguard liquidity in the sector. So far, we've been able to close 70% of the cases that came to us, at least for now. And in majority of the cases, we have agreed or are in the process of agreeing jointly with the other lenders and the institution on a tacit renewal of credit lines coming to maturity, which at least temporarily solve the liquidity issue. So what do we see now? The liquidity of institutions in our portfolio is quite high, given the debt renewal agreements that I've just talked about, but also the fact that their loan portfolio is going down. So institutions are keeping liquidity high due to the lack of visibility. And in some countries where the lockdown was lifted, we also noted the impressive ability of economies and institutions to restart the engine quite rapidly, showing that if the crisis is short, despite the violence of the shock, the resilience capacity of the sector is very good. Of course, we also lack visibility over what's going to happen in the future. And so it doesn't mean that the sector will be able to recover pretty quickly. So we thought initially that strict lockdowns would be efficient, but the curves have not even plateaued in some countries. So long-term perspectives are therefore quite worrying, first for the end clients of the institutions, the micro entrepreneurs, but also for the institutions themselves. At Symbiotics, we believe, if we talk about prospective analysis, that the SME sector is likely to be more strongly affected because it's more connected to the global economy than the micro enterprise sector. So typically, SME businesses located in countries where GDP substantially relies on the tourism sector are suffering now that European and American people do not travel this summer. And it will probably reflect in the financial institutions portfolio at a later stage. So how is it affecting our organization? Well, logistic-wise, as any other organization with operations abroad, it's not possible to travel, and our essence is to be close to the field to be able to bring fresh information to our investors. So we'll therefore have to innovate to stay close to our partner institutions. From the fund side, the funds that we manage and advise have so far been quite resilient with little to no redemption, and they have showed willingness to support the sector. This is mostly visible for the debt refinancing coordination principles that we signed with all the major MIVs. From the origination side, our funds continue to originate loans quite substantially, although it requires more intense efforts with institutions for reporting, but also with the investment committees of the funds who obviously want to know more about what's going on the ground. New investments are more challenging, obviously, given the operational situation in most countries where we operate. The crisis is also affecting our ability to finance early stage businesses, which are even riskier in such crisis times. So yeah, difficult to finance these businesses for now. There's also a challenge on the data analysis. We face an issue of time lag between the reporting and the situation on the ground. So what happened yesterday will be reported tomorrow to us and may not be true anymore because the situation is evolving quite rapidly. So which means that we need to show reactivity and agility in what we do. And that's why I was saying it requires more efforts to originate loans because an institutions that may need fund today may not need it tomorrow due to the volatility of the situation. In terms of data consistency, there's also another challenge because institutions may report differently loans under moratorium, which is mostly driven by what the regulator tells them to do. And this is making data aggregation quite challenging. So what are we going to do about it? Our primary and most obvious impact is on small and medium-sized institutions. And we obviously remain very committed to this segment. So far, investors have been very understanding of the situation. They've been ready to invest in companies on which we are not able to make a field due diligence, ready to renew even in a challenging context, because they know it is in the interest of everyone, including themselves, to support the industry. Depending on the length of the crisis, we will have to find longer-term solutions. And I liked a post from the Center, a blog post from the Center for Financial Inclusions that was saying, rather than thinking of the effects of the COVID-19 as coming in waves, it may be appropriate to see them as a sea change that we need to adapt to for the long haul. On our side, and I'm finding it quite true, we will need to find longer-term solutions to the operational challenge that we face. And that could be for us, for instance, pooling resources with other investors to outsource due diligence tasks to local company because we cannot travel ourselves. With DFI investing substantial amounts of money to support the sector, it forces us sometimes to be quite agile also. And so we are also very much willing to participate to syndications to have a greater impact on larger institutions. And we actually just closed one with IFC in West Africa last week. And we're really happy to be onboarded on those syndications to also have an impact on larger institutions. While liquidity issues were widely addressed over the last months, we don't think there's liquidity problem for now, at least in our portfolio. There's no doubt that some institutions will face serious solvency issues as as debt providers, we will not be able to find concrete solutions on this issue without the support of equity investors. So typically, conversion of our debt into equity or making investment at a loss because of hedging costs are solutions that we're ready to consider, but as a last resort, because we obviously need impact, but also we need return. So a good dialogue between equity investors and debt providers will also be key. We are also looking into raising funds, providing soft equity, tier 2 capital ahead of the growing solvency issue, because these funds will be very much needed. And so we are willing to manage such type of funds. Talking about greater collaboration needed, and I'll quickly finish on that. There's obviously greater community collaboration needed among MIVs first on topics such as data reporting and how we deal with financial covenants. We want to be as pragmatic as possible, but we also need to have a coordinated approach to be as efficient as possible and not overburden the financial institutions with numerous and contradictory requests. So there's definitely a need for coordination at our level. We see the cooperation between DFIs and the private sector to be key in supporting the sector as well. We need to complement one another and not compete with each other. And last but not least, there's already an interesting forum of discussion going on between a coalition of major microfinance networks, including FINCA and MIVs. We think this collaboration will also be key, with on the one hand, MIVs needing to show flexibility in finding financing solutions suiting the requirements of the FIs, and on the other hand, FIs, financial institutions, providing quality information and as much visibility as possible on the situation. This is because this is key for us to tell our investors what to do and where to invest and to provide support. I'll stop on this and we'll be happy to take any questions.
Thank you, Jérôme. Really interesting to hear your perspectives and how they compare and contrast to that of IFC, Symbiotics being a private sector investor. A lot of ways in which it sounds like you're seeing a lot of the same things. Again, really appreciate your insights into this. I'm going to turn now in a moment to Andrée Simon. She is the president and CEO of FINCA Impact Finance, which is a global network of banks and institutions that serve over 2 million women and men in 20 countries around the world. And beyond her current role, Andrée is a leading thinker and advocate in the field of responsible financial services. She was named one of the top 100 FinTech for SDG influencers by Lattice 80 and has written extensively on this topic, including for Your Money and Financial Times. Really excited to get Andrée's perspectives on these issues as well. Andrée, over to you.
Well, thank you so much for inviting me, and I'm going to echo a lot of what Jérôme and Momina said already. First by thanking CGAP for bringing us all together around data, which I think is really the crucial information that we need right now to inform the strategies as we move forward. And also to really thank Jérôme and Momina and the other players in the sector. I think that people have just come together to share information and insights in such a collaborative way. And that's definitely, as Jérôme said, what's going to be needed as we move forward to be able to address this. So I guess I'll focus my remarks, since it was so well covered, I'll focus on the differences that I see in terms of the data or some of the watch-outs. Because for the most part, we are definitely tracking to the data that you are reporting in terms of liquidity and CAR and restructuring. We do have, I think, slightly more efficient operational liquidity relative to some of the institutions that are reporting here. So I think that in the near term, we also feel very confident about the window that we're looking into over the short and medium term. But, you know, as Jérôme said, the concern that I have is, as we look out into the future, what the appetite of the investors and others will be to support the sector. And I do think that we're going to have some additional bumps in the road into 2021 when institutions are starting to refinance again, and what will that look like? The other, I think, important thing to note, and you have spoken to this to some extent, is around the portfolio quality and visibility into portfolio quality, because I do think that the restructuring is really obscuring to some extent, you know, what the true risk is. And so I thought I'd share with the audience, for what it's worth, we have done an evaluation of how our restructuring portfolios have performed in past crises in different countries. And there are obviously lots of factors that need to be taken into consideration. But, you know, on average, around 30% of restructured portfolio has proven to not be recoverable. And so the question I think that we sort of need to think about here is what's different about this crisis relative to those crises. And you know, using the past as a predictor of the future is always a little bit suspicious. But as we look into this, you know, can we expect the recoveries to be slightly higher because a lot of the restructuring was mandatory? And I think the point that both Momina and Jérôme made about having to look on a country-by-country basis and take a really balanced view of what the likely impact on that restructured portfolio is going to be required for us to see our way through on that. But otherwise, you know, we do see that our Middle East, South Asia region and our what we call our Eurasia region, and you all call ECA, are performing stronger, and we still see some continued fragility in LAC and in Africa. I will say, though, in a spot of good news, as an update, we are seeing our PAR 30 numbers coming down across the network in real terms. We have also, of course, seen a reduction in our global portfolio because we did reduce lending and are being very cautious about resuming lending in the markets that we're operating in. But I think that speaks to the good news that Jérôme alluded to around the resilience of our sector. That our clients, historically, when you look at how they have come through shocks, there's very small businesses that are high margin but low volume, tend to be able to pivot very quickly post-crisis to restart. And I agree with you, Jérôme, that I think that segment relative to SME is going to rebound faster. On the bad news side, though, we did share some data that we have collected from our clients in a customer survey across the network. And we find that 73% of our clients are very concerned about the future. Now, admittedly, you know, that data also is from over a month ago, and so they may be less concerned today than they were then. But it does speak to that question of dampened demand and whether or not, I think as one of the commenters noted in the chat box, the appetite for loans is going to be there. So I think we do have a good news, bad news kind of situation. Of course, we've had also on the bad news side just the impact of the virus itself on our customers. We've had customers not only whose businesses have been affected, but we've had a loss of life across our network. And obviously, we're paying very close attention to that. And I think that even though we feel like in many places we're starting to get through, I am going to use the term wave, Jérôme, but through the first wave, you know, we don't know when or even if, but I think more likely when that second wave is going to come. And so that makes it hard to predict when we're talking about forecasting, which we are doing right now, obviously on an almost continuous basis, to see what the future is going to look like. Having said all of that, I think the other piece of good news in some ways is that in a crisis, it's very easy to align teams very clearly around what needs to happen, because it's just a very clear imperative that we need to get through this. And so at FINCA Impact, we have accelerated the finalization of call centers, which I think is reflected to some extent in your data. We already had, going into the crisis, over 55% of our transactions across the network happening digitally, but we've certainly seen that our ability to interact with our clients remotely has a material impact on being able to continue with operations. And the fact that we're in that situation is allowing us to accelerate that even further. I think the big challenge as we look forward is just what Jérôme said, which is it is a sea change. We are not going to go back to normal. We have to adjust the way that we do our business, not on an interim basis, but on a permanent basis. And I think the other really big challenge that institutions like us face in particular, but I think it's affecting everybody that I know, is how are we going to sustain the levels of energy that we need to have to execute on all of this? Because the reality is that there is a certain weariness, I think, that is coming across a lot of folks, having to deal with this uncertainty and having to deal with kind of the ongoing challenges, real challenges and real bad news that are coming out of this. And so we do have to think very explicitly about how we are going to sustain people as we move through this crisis as well. In terms of what we're planning to do about it, we've had a pretty aggressive operational recovery plan in place. We moved very early to do that. So we have implemented hiring freezes and travel bans, and we do talk about wellness activities across the network. We have pushed the use of different webinars and online chats. I think that, you know, prior to this crisis, everyone was slightly ambivalent about the various digital platforms that we had to communicate over, and it's extraordinary how efficient we've all gotten at navigating them, but we need to do more. On the process side, we need to continue to reduce the human touch points that are necessary to do our business, but without sacrificing the human aspect of it, which is no mean feat. But I think that for the client base that FINCA serves in particular, there is still a lack of experience with digital technology in a lot of countries, a lack of access, and frankly, still a lack of comfort with formal financial institutions. And it is that human interaction that facilitates onboarding people into the formal financial sector. And so we have to continue to leverage the digital tools to make it easier for clients to use their money, but also maintain that front line of human contact and or touch via digital that allows people to grow more and more comfortable with those digital interactions. And I'd say that's probably one of the biggest worry beads that I have, and I think a lot of others have around the emphasis on digitization, which is just that not everybody is digital yet, and there is quite a bit of work that we need to do to get folks onboarded into that digital economy effectively. And we need to not forget about those people who are still not in there. And then, you know, the last piece is around planning. And I think this ties very much into the greater collaboration piece as well. Obviously, FINCA has been collaborating with our friends and colleagues at PRFI and CGAP and the World Bank and IFC and the MFIs, very importantly, to try and share as much information as we can. But as we look to the future, we do need to have a common view around the stress testing and the forecasting that we're doing in order to bring people together constructively around these discussions and help us all to make some of those strategic decisions that inevitably we are going to have to make. And I think that if any industry can do it, this one can, because we do all share a common goal, which is to help people improve the quality of their lives through responsible financial services. And that's more than just a commercial goal that we have. And I think it will really unite us all in trying to address this. Thank you.
Thank you, Andrée. And that's a great note to end these opening comments on of thinking about the customers at the end of the day. It's great to hear your perspectives as really closer to the end customers who we're all in this for at the end of the day. We're going to turn over in just a second to go over some Q&A that's come in. But before doing that, I'm just going to return quickly to Slido. So we'll see where these responses have been. So first on the solvency crisis, we see somewhat likely is about where the majority of the opinion is, that there will be a solvency crisis sometime in the next 6 months. One moment here. Liquidity, slightly more. So slightly more people see a potential liquidity crisis. And then lastly, what's driving the higher liquidity that we see among some institutions? Most people are saying risk aversion, which, Andrée, to your point, is potentially concerning because, you know, that means that we're putting this burden of the liquidity crunch onto the customers at the end of the day, if that's true. On the other hand, I did see in the chat somebody saying that in some places that I think it was in Nepal, someone mentioned that their challenge is they have more cash than they know what to do with. So there it really seems like lack of demand is a big challenge. But in any case, very interesting to see the audience's feedback on these issues. I'm going to open up one last poll. And this is just to get your feedback on how we did on this webinar. So how did we do overall on a scale of 1 to 5? With 5 being excellent. And second, how useful was it? So maybe we did a seamless webinar, very interesting, but was it actually useful to you in your job on a scale of 1 to 5? Follow-up, using 1 to 2 words, what areas would you like to see us dig into further with this survey in particular? And just 1 to 2 words, because this is a word cloud question. And then anything else you want to tell us. So I'm going to leave this survey up, but turn things over to Peter now to moderate the last part of the Q&A before we sign off in just a couple of minutes.
Yeah, thanks for that. So we're going to open up for questions from the audience. We've been collecting questions throughout the session already, and some answers have been offered in the chat, but we'll try to also speak to them now. I want to emphasize again that there are 2 separate channels for this. If you have a question, please use the box in the WebEx labeled Q&A. Please indicate if it's for a specific person. Feel free to share your name and country and organization. It's not mandatory. Feel free to do that. If you want to share your own views, comments, or experiences, then please use the box labeled chat. Feel free to say what you want there. We'd be interested to hear your own experiences, what you're seeing in your own markets, what you think is most badly needed for the sector. But I want to take a few of the questions that have come in already and pass them back to our audience. Andrée spoke about the need for going digital as part of this new normal. There have been several comments about that as well, and some of the audience members have rightly noted the cultural and the IT infrastructure challenges and so forth. Digitization has, of course, been discussed for many years in the MFI space, and it's largely proven difficult. My question, to sum up from the audience and from myself as well, to all of the panelists, maybe Andrée, first since you spoke of that, is what needs to change for this to finally be successful? So there's been no shortage of attempts made to digitize MFIs, and the crisis now puts a different emphasis on that and importance to that. What needs to be done differently for this now to actually happen?
Great question. I have some thoughts. I think that as a sector, we have chased technology at the expense of process. And fundamentally, this is an opportunity, particularly, given the fact that we're going through this crisis, to really think about the process of delivering responsible financial services to clients in a much deeper way. And I think that any institution can amend process to make it more efficient right now without necessarily having to invest in the technology. And so those changes need to be accelerated because they will have a positive effect and they will set institutions up for being able to leverage those investments when they become feasible from a cost perspective and a technology perspective. So that's part one. And I think injected into all of that process, there are opportunities to digitize that are relatively simpler to execute, such as workflow management, that don't require kind of one of my colleagues calls it the big shiny toy approach to digitization. And so it's that very pragmatic lens that I think we can all have on that. The second, I think, is, again, looking at what the digital ecosystem looks like in each of the individual countries. And I guess I'll parse that into two parts, which is what's the connectivity like and the infrastructure and the cost of data to clients, and how realistic is it for that to be addressed in the near term. And then, on the other side of it, how will clients be able to interact with their money digitally through the tools and infrastructure that exist. And so in some respects, it goes back to that HCD, very client-centric focus that the industry was really, I think very, very focused on even 5 years ago, which is it was being a little bit more grounded in what's realistic for the client base that we're trying to serve, and designing those solutions around it. There really aren't, I don't think, any quick fixes to those. It's not, as much as I fantasize about, being an equity bank, in reality, it's very difficult to replicate that kind of model because so much is dependent on the local conditions and the local marketplace. And so we have to really share, I think, as much as we can about those practical learnings that we have around process. And right now, take all of the measures that we possibly can to set ourselves up to be on that digital pathway, but maybe we won't be there immediately.
Thanks, Andrée. Those are great comments. Maybe I'll pass to Jérôme, partly the same question on digitalization, but maybe to broaden it out, to speak a little bit to those changes to practices that are needed to adapt to the new normal, which both of you mentioned. If you want to speak to sort of what you see as the key elements of that. So digital is one part. and feel free to speak to that challenge as well, but what are the other sort of key elements of what has to change and what's going to be the hardest part to do?
Thank you, Peter. I think what will be interesting with digitalization is that, for now we've seen institutions being very successful in implementing digital tools to serve their channels, and some other institutions that were not going into digital that were still quite successful in what they do. And the changes that we see today is that most of the sector will have to move towards digitalization. And so for us, we're not the experts are really the FINCAs and all the institutions that are working on the ground. So for us, what we do is that we look into the risks of these institutions, and having the entire sector moving into digitalization means looking at new opportunities for us, but also new risks, because as André say, there's a lot of ways to go into digitalization. Some are very expensive and may not be as efficient as we hope. And so that may mean also business models trying to adapt to this new change into digitalization and failing to do so. So obviously, for us, that will really be about looking into this new topic. Not topic, but at least this new change for the entire sector, and making sure that all the business models are ready to adapt to this.
Excellent. Thanks very much for that. And I am keeping one eye on the clock, and I am unfortunately noting that we are out of time. We're going to go to 10:30, and we're already a few minutes over. I want to be respectful of the time of our audience, and of course of our panelists as well, who have been very gracious to join us already for an hour and a half this morning. I think this has been a great session. I will pass back to Alex for a few closing words.
Thanks, Peter. And just to thank the audience for sharing their feedback with us, I'll just display these things here quickly. So for the most part, you told us that this was a good webinar. Thank you very much. We're glad you found it useful. Similarly, lots of things for us to dig into: solvency at the top of the list there, welfare problems. We will take this into account as well for the future, and some other things where we can look into. I'm going to leave this poll up. If you have more feedback, please do share it with us. We will read it, study it, and it will affect our plans as we go forward. And as Peter said, just wanted to close out by thanking everybody. And one last reminder to please do fill out the survey. Encourage investees, grantees, any MFI you know to please fill it out. It's a global public good, and we think it is an important tool to help the sector navigate the crisis. For more information about it, you can go to cgap.org/pulse. And again, thank you everybody in the audience for joining, and a real special thanks to all of our panelists. We really appreciated getting your insights from your direct experience on these issues. That concludes today's webinar, and we hope to see you at the next one.
Thank you. Bye.
Goodbye.